In this video, we're going to look at when companies buy on credit. When a company buys on credit, what they will do is they get about 30 days to pay for their purchases. So let's take a look at the same example we looked at earlier. Here are two companies. We said the Cowboys organization was one of the companies and Pepsi Corporation was the other one. So Cowboys places an order for products with Pepsi, and then Pepsi delivers the product to the Cowboys. Every time Pepsi delivers their products, the Cowboys organization does not pay for those products. Pepsi keeps track of all the orders that were delivered during the month and then sends Cowboys organization an invoice, and then they have about 30 days to pay Pepsi the amount on the invoice. In this example, keep in mind that the Cowboys is the buyer, Pepsi organization is the seller, and the Cowboys is going to be having a credit purchase. So they buy on credit, or sometimes we say they buy on account. Let's look at this in more detail. To recap, sometimes companies buy on credit. We call it buying on account as well. They both of them mean the same thing. When companies buy on credit, the company does not pay cash immediately. Vendors offer about 30 days to pay the bill, sometimes more, but typically 30 days. For offering that credit, vendors do not charge any interest. So whenever a company buys on credit or buys on account, there is no interest charged for that 30-day credit period. Accounts payable is the account that shows the amounts owed to a vendor for credit purchases. So you're going to see a new account that we're going to use called accounts payable. At any given point in time, accounts payable shows the amount that the company owes to vendors for their credit purchases. Accounts payable is a liability. Most liability accounts have the word payable in them. Not all of them, but most of them. So anytime you see an accounts payable, salaries payable, or something which we're going to talk about later, the word payable means that account is a liability. Let's go take a look at an example. In this example, it says Valor Company experienced the following events during its first year of operations, which is year 1. Again, who are we? We're always looking at things from the point of view of Valor Company. And this is the very first year of operation. So before this date, there were no assets, no liabilities, no stockholders' equity, no revenues, no expenses, no dividends. So all the accounts had 0 balances. Let's look at transaction 1. Transaction 1 says acquired 500,000 cash from the issuance of common stock. So what happened to the balance sheet right after this transaction? We know that the company's cash increased by 500,000. Cash is an asset, so under assets, I will say cash. And for transaction 1, I'm going to show a positive $500,000. What else happened? Well, we issued common stock. So we know that the company's common stock increased. Common stock is a stockholders' equity item, so under stockholders' equity, I will say common stock. I'm going to abbreviate here. Common stock, and common stock increased by 500,000. By now, this transaction should be pretty second nature because we've seen that so many times. Now let's see how this transaction affected the income statement. Income statement has revenues and expenses, and then it calculates net income. Well, transaction 1 didn't have any revenues or expenses, so it did not affect the income statement. Let's look at the statement of cash flows. Did this affect the statement of cash flows? Yes, it did. If there's cash involved, it affected the statement of cash flows. So we know that the company had $500,000 of cash inflows. Now we just need to identify what type of activity it is. We know that anything to do with common stock or stockholders' equity and long-term loans relate to financing activity. So this is going to be a financing activity. Let's look at the next transaction. For transaction 2, it says incurred $200,000 of operating expenses on account. So remember, what does incurred mean? We talked about incurred earlier. Incurred means the company used up $200,000 of operating expenses. Did they pay for it? No, they didn't, because they used the word on account. So what we're going to do is we're going to recognize, which means record, that the company used up $200,000, but it was on account. So how did this affect the balance sheet? We know that operating expenses increased. So if expenses increased by $200,000, what effect does it have on the balance sheet? We know that expenses have the effect of decreasing retained earnings. Retained earnings is a stockholders' equity item, so I'm going to put retained earnings here. And retained earnings are decreased by expenses, so I'm going to put that $200,000 as a negative number. Expenses increase, but expenses have the effect of decreasing retained earnings. So negative $200,000 here. So that took care of one side. What else happened? Well, we know that whenever the company buys goods or services on account, it goes to accounts payable. What type of account is accounts payable? Accounts payable is a liability. So under liabilities, I'm going to say accounts payable. And my accounts payable, did it increase or decrease? Before this transaction, I didn't have any accounts payable. I didn't have any debt. Now I have $200,000 of debt. So I say that my accounts payable went from 0 to $200,000. It's an increase of $200,000. So I'm going to put that as a positive number. Now let's see whether this transaction affected the income statement. Did it affect the income statement? Yes, it did. We know that our expenses increased by $200,000. So I'm going to put $200,000 on the expenses column as a positive number. The $200,000 expenses has the effect of decreasing net income. Net income decreased by $200,000, so I'm going to put that as a negative number. Why did net income decrease? Because we know revenues minus expenses is equal to net income. So if our expenses increase, net income will decrease by that same amount. Now let's look at the statement of cash flows. Did our statement of cash flows get affected by this transaction? Did we have any cash with this transaction? No, because it was an on-account transaction. If you look here, there's no cash affected by this transaction. So if cash was not affected, the statement of cash flows is not affected, so we're going to leave that blank. Let's look at the third transaction. Third transaction says paid $150,000 cash to reduce the balance in accounts payable. So what's happening here? Now the company is paying back some of this debt, some of the accounts payable. Are they paying all of it? No, they're only paying some of it. So let's see how that affects the balance sheet. We know that when we pay, our cash decreases. We paid $150,000, so our cash went down by $150,000. And then once we pay some of that accounts payable, we don't owe $150,000 of it, so we're going to decrease accounts payable by $150,000. That takes care of the balance sheet. Let's look at the income statement. Did this transaction affect the income statement? No, because these were not new expenses that we incurred. We were just paying for the expenses that we incurred earlier during the year. So there is no expenses in this transaction, therefore the income statement is not affected. Let's look at the statement of cash flows. Is the statement of cash flows affected? Yes, if cash is affected, statement of cash flows is affected. Our cash decreased by $150,000, so we know that we have an outflow of cash of $150,000. What type of activity is it? This is paying money for expenses. Therefore, expenses are operating activities. Expenses are things that we do day to day to stay in business, and that is considered an operating activity. So I will put OA as the type. That's it for this video. If you have any questions, please let me know.